This is Sean Overton with OneStepRemove.com, and today I'm talking with Batur Asmozoglu.
That's good.
All right, yeah, I was worried about butchering that. Not exactly a common name, but Batur is Turkish, and I'm here in Istanbul. I've been working with him for the past month, and I've been working on the same project as he is, but we come from totally different backgrounds. So obviously I run One Step Removed. I'm a programming and algo company. And Batur's background is that he's worked at every major bank that you've heard of. Credit Suisse, Deutsche Bank, HSBC, and everything that he's done in those banks is he's done FX trading. So he's made markets, he takes positions for the bank, and the great thing about this month is I've learned a ton of what it actually is like to be in the center of the Forex world. And Batur has been telling me a lot about his experiences, and I thought it would be great for you guys watching to get a sense for how the big banks actually take their positions and what they actually do on a day-to-day basis. We've been having some good laughs. One of the systems we're trying to reverse engineer is from Forex Factory, and you see a lot of conspiracy theories about how all the big banks are out to get you and how they've got this obsession with getting the most out of every single person, and it's just not how it is. And I'm really technologically oriented, so my big view of the banks was that they're super sophisticated and they've got this great knowledge and information and scientific method for why they do things, and that's not the case either. And I've learned that.
Not really.
And I've learned that from talking to Batur for the last couple of months. So I just wanted to ask him a couple of questions to get a feel for what it's like, and then we'll go through it. I don't know exactly how long the video is going to last, but it'll probably be about 20 or 30 minutes. So Batur, thanks for agreeing to be on camera.
No problem.
So you started out working as a trader for a private client here in Turkey.
That's correct. I started managing money for one of the local billionaires and then moved on to a fund management house in Turkey. And then moved to HSBC, Credit Suisse and Deutsche in that order, managing FX positions and local currency bonds mostly. What I did was mostly emerging markets FX trading, but I have done some euro-dollar and I have done some Aussie as well.
Okay, so you just stumbled into working for a billionaire.
Well, it's kind of, we are from the same school, so that kind of helped. But they were basically looking for some young people who they could teach what they wanted to do with.
Okay.
We had this one guy who was an ex-Deutsche trader. He actually built the whole system up from the ground, so I was one of the recruited ones from the school.
Very nice. And when you got your experience in the banks and you started working, how do they actually train traders? Like when you're an institutional trader, what do they do to teach you?
Well, most people think banks are very sophisticated and they have plans for everything. The reality is, especially the London investment banking, is actually not sophisticated at all. The people themselves are sophisticated. They come from good schools and strong backgrounds. However, the banks have invested very little money since the 80s and the 90s in infrastructure and software development. So most of the software is from 80s. Even Reuters today was made in 75, I think.
Okay. Reuters is probably one of the biggest FX platforms in the world, by the way.
The banks themselves don't really invest much into the people either because the turnover is very huge. They don't really know who's going to lead when. So basically you're pretty much alone with your instincts and your gut feelings. But there are ways to learn from the older generations. They are usually there to be a mentor, try to teach you stuff, but there is really no sophisticated way of raising a good trader from the ground up.
So you've talked a lot about the lifestyle and the pressures of working in London as a trader, and you just mentioned the high turnover. And you've also mentioned a lot of the star traders go to hedge funds. Is that all the turnover, or how many people wash out?
Well, basically, let's say 10 people start up this X investment bank in London at some point. If the product that you're dealing with is profitable, that meaning for the last 5 years, let's say, bonds have been very profitable because of the low interest rate environment. Euro-dollar has been relatively profitable, but let's say CHF has not been profitable because it doesn't move much. It's not volatile enough. So if you're lucky enough to be in the right product market, then you have to be better than the 7 or 8 other traders, because basically in a bank most people think there's around 500 traders when they see the pictures of the large trading rooms, but the truth is most of those people are M&A people, equities, sales. In the largest FX bank, which is Deutsche, at the moment there's about 70 FX traders. So not that many, and every year a lot of people leave the school to become a trader. So at the end of the day, 10 people start into the first year, some of them have already left. At the end of 5 years, there's barely 1 or 2.
Okay.
Most of them, in a funny way, leave by themselves, because the pressure of trying to make money gets to you very fast if you don't really have the talent.
Right.
Yeah. So
imagine that.
yeah, well, basically the bank takes you on as a fresh starter. What's different than most people would expect is they want you to start making money right away.
Okay.
In a small way, maybe with help from other people, but they really don't give you 6 months to get a hold of yourself and learn about the place or anything. So if you're lucky enough to have the guts to try this, and if you're lucky enough to get the right trades done at the right time, you might have a 6-month start.
Okay.
But I mean, personally, I'm guessing there's more luck in play there than real knowledge, because first 6 months, if things go bad, sometimes it's just bad luck.
Okay. And I noticed that a lot of the positions that you talked about, not just for yourself, but for all bank traders really, it's not this crazy intraday technical analysis with a mechanical system. It's the exact opposite of that.
The truth is, about while I was trading at the bank, I've seen very little technical analysis at all. The main reason for this is the bank is the market-making exchange. The bank is the place where the market is made when there is no prices in the market. So if you're the market maker, if you're the price maker, you can't look at historical data and make up a price for the events that are happening right now. If you have events happening today, like let's say Lehman Brothers in 2008, you need to have a real person sitting at that desk, not looking at the historical data, but looking at the customer flow, most importantly, and the events and what they understand from them translates into the price action in the day. One of the main reasons why a trader can't really trade intraday is because constantly you have customers taking prices from you. So you don't have the luxury of sitting down and like looking at charts and Fibonacci levels or stuff like that. Because average trading rate of a euro-dollar trader is about 10 to 15 deals a minute when it's really going.
Okay.
So he doesn't really have the time to look at things or anything, but if he's a good trader, he will have come in the morning. He will have prepared some scenarios with different outcomes in case a data might come in or whatever might happen. So he's going to be prepared for pretty much whatever might happen. And the difference basically is while these trades from the customers flow in, all he does is he buys at some predetermined level that he thought about in the morning. He usually doesn't even know the exact size because of the customer deals always flowing in.
Right.
You never actually know your position exactly,
Okay.
because there is no software developed for this.
So you don't know whether you're net long 50 or 70?
No, not really. Because the average flow is anywhere from $50 to $250.
Okay.
Most pound and euro dollar traders carry positions around $200 to $300 worth.
And when you say dollars, that means million.
Yeah, $1 million, yeah. And that's basically only to cover the customer flows.
Okay.
So if he wants to put on a large position, it has to be around $500 million.
And I think that's a real key distinction that's probably going to go over most people's heads. So when we talk about trading, we're used to seeing the prices just flicking on the screen and come from this magic box. And I always just thought that there's some super scientific algorithm designed by PhDs that's fluttering this across my screen, but that's not the case at all. It's really, the banks aren't taking positions, they're accepting positions, they're making a market.
That is true. There is an algo department in every bank, and they have made money in the last 5 to 10 years, but they're proving to be less and less profitable because the more algos there are out there in the market, the less profits there are to actually get. So yes, there are algo trading teams, but they have never been more profitable than a good FX trader. A manual trader has never been beaten so far. The largest P&L I've heard from an algo was around $5 million a year, I think.
Okay.
And that would, with $5 million, you wouldn't be able to keep your job as a manual trader.
Okay.
So it's a little different than what people think. But I would say the day traders who trade with the brokers mostly trade with algos. To be able to have access to a manual trader, you would have to have significant capital, more than $50 million definitely.
Okay, so that's just hedge funds and
Yeah.
pretty good sized institutions.
Pretty much.
So when you're trading, that's just a totally different concept. And the one thing that tripped me up before was we talked about market making. I only trade when I think I have an advantage.
Yeah.
But when you're making a market, you don't get that luxury. Why can't you pick your own positions?
Well, let's say you're market making for euro dollar at Deutsche Bank.
Okay.
They have around $20 billion of flow a day.
Okay.
And you basically have to manage the larger sizes. So around $5 billion of this is going to have to be manually made.
Okay.
You're going to take a position at some point, obviously, and you're going to want to be long maybe 100 million euros. And then some other guy in a London hedge fund will come and sell you 500 euros, let's say, 500 million euros. While you're trying to sell that, some other hedge fund from France will come and they will buy 750 million euros.
Okay.
While you're actually serving these clients, you're getting a very important set of information actually. You're understanding what the European hedge funds, the European real money guys are doing,
Okay.
and what the London guys are doing. If you understand the market correctly, you will know why these guys are doing these things. But there's a cost to it, obviously. The cost is that you're giving them liquidity. So for you to hold on to your own position is very hard.
Right.
So the only way to keep your position is actually to predict what's going to happen. So if your dollar is going lower because of some euro negative market news, you have to be as much short as possible, pretty much, because the customer's flow, when it starts to flow in, it's not going to give you a break so you can put back your position on or think about it.
Right.
So people usually do whatever they can in the time they have, and then things fall into place in about 2 to 3 minutes. But the volatility in that region is crazy. And most people, when I read the chat rooms and the platforms and everything, most people think actually there are traders trying to target certain levels in euro dollar or anything else. Traders do trade at certain levels, but actually if you think about it, the levels are dictated by the customer.
Okay.
Because wherever you put your stops, the market goes to. If you put $1 million worth of stops, it's nothing. But if, let's say, 90% of the hedge funds in the world puts a stop loss at euro dollar at 100 pips from here, naturally a euro dollar trader would have to start buying before it hits that spot. Because after you hit the stop loss, it's too late to buy 700 euros.
Right.
So naturally, euro dollar trader starts to build up the position for that stop, because when he hits there, he doesn't want to lose money. So he doesn't actually try to stop people out, but to keep himself in a comfort zone that is actually understandable by his bosses.
Right.
He has to keep buying as the euro dollar approaches the stops.